Hey, welcome Senator Hueso. There are other senators on the committee and a couple of assembly members as well who have expressed interest in the topic. Actually, there are many people interested in the topic, but they have a lot of conflicts, so people will be in and out, is my guess, as the meeting goes on. We won't be voting on anything today. This is an oversight informational hearing, and as a result, we won't need to establish a quorum, and as I said, members will be in and out. I want to also particularly welcome the witnesses today. Several of you will be testifying before the committee. We'll talk about ground rules in a little bit. I want to welcome other members of the public who are not on the panels to testify, but there will be time for public comment at the end, and anybody in the room will have an opportunity. I'd also like to thank those who are viewing this on webcast or on the television feed. We're here today to learn about the potential impacts of proposals by the Federal Consumer Financial Protection Bureau, CFPB, proposals they're considering in the areas of payday and installment loans. And I will continue to use the acronym CFPB because we've now disclosed that's Consumer Financial Protection Bureau. But as individual witnesses come up, please, the first time you go to use an acronym, tell us what the whole spelling, what the words are, and feel free to use the acronym after the first time. The proposals have potential to impact billions of dollars in loans made annually here in California to millions of California consumers who rely on them and thousands of people employed by the lenders who make those loans. So this is an important issue for the California legislature, although we're not the ones crafting the new rules. That job is being done federally by CFPB. It's important that we understand the potential impacts and can react accordingly and give input accordingly as well. In the end, we may choose to conform to the new rules, or we may go beyond them and be more protective of consumers, but we will not be able to reject them. If we don't like the final product, it doesn't matter. All of the states will abide by these final rules. For these reasons, it's very important for the California legislature, the Senate through this committee, to take an early look at the CFPB proposals, not just the written proposals or at least the summary of ideas they've given us so far, but also to hear from those who will be affected, both on the consumer side and the business side. Key questions we're interested in this committee are: how many Californians will these proposals help? Will Californians who are caught in an endless cycle of debt be able to escape those debt traps if these proposals are enacted? On the other hand, how many Californians will these proposals hurt? And will Californians who currently rely on payday or installment loans, if they have emergency needs, will they have anywhere else to turn when those needs are apparent if these proposals are enacted? And will Californians lose jobs if these proposals are enacted? So those are the kinds of things we want to get to. We also need to decide if we as a California legislature need to weigh in on these proposals before they're finalized. As most of you know, CFPB convened a small business advisory review panel in Washington, D.C. last week to hear from small entity representatives. We're fortunate today that some of those who testified last week are here with us today, and we'll hear what they have to say. We'll also have a more diverse panel than CFPB convened, and we'll hear from others who weren't able to present last week. In releasing its proposal 6 weeks ago, the Bureau made it very clear they're interested in hearing from interested parties about these proposals. And those interested parties include all of you, include the California legislature. Before we get started, I'd like to remind witnesses and those in the audience about a couple of ground rules we've established to make this hearing run more smoothly. We're going to have 4 panels, a couple of the panels divided into 2 subsets. During each panel, I'm going to ask members to let the witnesses speak without interruption unless there's something that's really emergent to comment on or ask about immediately. But best to hold questions till the end of each panel. The first and second panels, Brian Sala summarizing the CFPB's proposal and Commissioner Owen discussing potential state, welcome Commissioner, Commissioner Owen discussing potential state regulatory impacts resulting from the proposals. Each of them have been allotted 10 minutes, not including member questions or discussion. The third and fourth panels, which will address first the short-term covered loan proposals and then longer-term covered loan proposals, have each been allotted 50 minutes, 50 minutes, for the two sides, both in short-term and long-term. Within each of those panels, each sub-panel will be given 25 minutes, and it's really up to members of the sub-panels to police themselves. We're not going to be telling you when each individual on a panel needs to stop. But out of courtesy and respect to your other panelists, we hope that each panelist, the first few panelists, don't take up all the time, because then the people who came here who are at the end won't have any opportunity to speak. We think 25 minutes should be plenty of time to give initial remarks. Now, many of you have also submitted written commentary. We will accept additional written commentary in the next few days after this hearing if you want to get it to us, but only in the next few days, because then we're going to come up with a report from the committee. If you're a witness and you just agree with the previous remarks, the remarks of previous panelists, rather than repeating those remarks, just tell us you associate yourself with those remarks, and if you have anything additional to add, please do so. Also, if you were a member of the Small Business Advisory Panel convened by CFPB last week, please let us know that at the beginning of your remarks. We have a great opportunity today to hear from several who did speak last week, but several who did not, so we want to know who participated in that effort. And finally, for those of you in the audience who weren't invited to speak, as I said, there'll be time for public comment at the end. That comment will be limited to 1 minute of oral testimony per witness, but the committee will accept written testimony of any length from you. So if you have more than a minute's worth to say after we've heard from both panels, and they'll have covered most everything, but if there's more than a minute worth to add, besides just your support of one side or the other, please don't hesitate to provide to us in writing, either now or in the next few days, those additional comments, but only 1 minute of oral testimony. Before I call up any panel, I'd like to introduce Senator Wasa, who was with us at the very beginning, and Senator Galgiani, who just arrived. I'd like to thank both of you for being here. We have other members, as I said earlier, who may be coming and going. We have competing needs on our agendas. But Senator Wasa or Galgiani, do you have any initial remarks either of you wish to make? Okay, I like that. Okay, with that, I will call up Brian Sala as the first panel. He is the Acting Director of California Research Bureau, to give us an overview of the CFPB proposals. And Brian, thank you for giving of your time on this. And I know you've only had these proposals for about a week or so, and appreciate the work you did over the weekend to help us.
Thank you, Chairman Block, and thank you, Senators. Good afternoon. As Senator Block noted, my name is Brian Sala. I'm the Acting Director of the California Research Bureau at the California State Library. CRB's primary function is to provide independent, nonpartisan research and reference services to the legislature, the governor's office, and other constitutional officers. I'm here today to provide a brief overview of what we know to date about the language of the Federal Consumer Financial Protection Bureau's March 26th outline of proposals on consideration for a potential rulemaking for payday loans, vehicle title loans, and similar loans. My remarks will focus on 3 areas: where we are in the federal regulatory process, the significance and structure of the payday loan market in California, and the major features of the current proposal. And I'll try to be very brief on each of those. So where we are in the process, as you noted earlier, Chairman Block, on March 26th, the director of the CFPB, Richard Cordray, announced that the Bureau was publishing an outline of regulatory proposals on payday lending, which preceded an April 30th convening of a small business advisory review panel, included an invitation to stakeholders and other interested parties to provide input and feedback before the Bureau proceeds to a formal notice of proposed rulemaking. The Small Business Advisory Review Panel consists of representatives from the CFPB, the Small Business Administration's Chief Counsel for Advocacy, representatives from the Office of Information and Regulatory Affairs within the OMB, the Office of Management and Budget. OIRA is interested in things like costs of regulation and whether there are cost-benefit analyses that support those regulations. The review panel met with a selected group of representatives of small business to gather feedback on the current outline proposals. Additionally, these selected participants will have an opportunity to provide written comments, and the panel has 60 days from that April 30th meeting to issue a final report. Once a proposed rule is published, The panel's final report will be included as part of the public record on the rulemaking proceeding. Until a proposed rule is published, there is no other formal mechanism for the Bureau to receive and incorporate stakeholder input. As the CFPB has not yet formally proposed a rulemaking, its rules and policies regarding ex parte communications do not yet apply, which means we can talk to them in any manner we pursue, but they're not required to actually respond to any of the comments we provide to them in advance of the notice of proposed rulemaking. Once a notice of proposed rulemaking is published, the CFPB will then begin accepting on-the-record public comments on the proposed rules. On the payday lending market in California, I'm sure Commissioner Owen will have more to say about the potential state regulatory impacts resulting from the proposal in a few minutes. Here I only note a couple of salient facts about the nature and size of the relevant lending market. DBO collects data on both short-term deferred deposit transactions, roughly payday loans, and longer-term credit products under the California Finance Lenders Law. According to their latest report on payday loans, in 2013, an estimated 1.7 million California customers borrowed $3.1 billion in payday loans in 12.2 million individual transactions. The average transaction then pencils out to $260, and the average customer had 6.8 transactions in the year. There's a major caveat to that data. The data is reported by licensee, not by borrower. So it's quite possible that, that there's overlap across borrowers. In fact, it's quite likely there's overlap across borrowers. So the actual number of California customers borrowing is something less than 1.7 million, but we don't really know the exact number. A key question is about lengths of loan sequences. The CFPB has published a report on payday lending and includes some data on sequences of loans, where they define sequences as overlapping loans that overlap within a 14-day period of the termination of the first loan before they look at the second loan. So it's a little different from the language we're looking at in the proposal for sequence definition. The national data suggests that nearly 2/3 of all borrower sequences annually end with the first, second, or third loan in the sequence, but that half of all loans are in sequences of 10 or more loans chained together. Here, a sequence, again, is a chain of loans, each separated by no more than 14 days from the contractual end date of the prior loan. The data suggests that if the payday borrower has not completed the sequence by the third loan, about 40% of the time it will turn into a sequence of 10 or more loans. So here we're looking at the conditional probability of continuing the sequence given where you are in the sequence. So we need some information about duration data there. There is some question as to the adequacy of the data currently required to be reported to the DBO in order to figure out what those durations are in the California data. A second key question is how many loan sequences the typical borrower engages in during a year. National data collected by the CFPB, and this is about payday loans, suggests that 48% of borrowers had only one loan sequence in their study period, but that only 15% of borrowers had only one loan for the year. Okay? About half of borrowers had only one sequence, but only about 15% of borrowers had only one loan for the whole year, suggesting that there are many, many borrowers who are having sequences of more than one loan. And that added on to the 48% of borrowers had only one loan sequence, another 26% had only two sequences during the year, and it scales down from there. A third key question has to do with whether or how these loans are secured. And here I'm going to be talking about CFLL data on the longer-term loans. In 2013, DBO reports in 2013, CFLL license holders issued 908,000 consumer loans totaling $39.5 million. 69% of these loans were for amounts below $5,000, but 96% of the dollar amount was for loans above $10,000. CFLL loans under $5,000 tend to be unsecured loans. In contrast, consumer loans over $10,000 are predominantly secured by real property, autos, or auto titles. CFLL license holders also issued 1.3 million commercial loans, but we're going to focus here on consumer loans, so I won't talk about that. The proposal in brief. The first thing I'll note on the Bureau's proposal is a definition of loan sequences. A loan sequence is defined in the outline as any set of covered loans obtained by a borrower, regardless of lender, where the contracted beginning of a loan, renewal, or extension is within 60 days of the contracted endpoint of the prior loan. So again, that's different from the data that the CFPB has reported in its prior reporting on payday loans, which looked at a 14-day overlap period. On covered short-term loans, so there's a question about what loans are covered. The covered short-term loans are those with contractual durations of 45 days or less. Covered longer-term loans have contractual durations of more than 45 days and an all-in annual percentage rate of over 36%, and the lender obtains a preferred repayment position by one of two things: either access to a consumer's account, a credit card account, a prepaid account, a checking account, or a non-purchase security interest in the consumer's vehicle. Loans not covered include short-term pawn loans, credit card accounts, real estate secured loans, and student loans. The CFPB states that it is concerned that many consumers are taking out unaffordable loans because lenders are offering credit without determining whether consumers have the ability to repay the debt on time. The outline identifies two possible response strategies labeled debt trap prevention and debt trap protection, respectively. On debt trap prevention, the CFPB is considering a, quote, rebuttable presumption that the consumer lacks the ability to repay a second or third covered short-term loan or covered long-term loan with a balloon payment in a sequence, and a conclusive presumption of lack of ability to repay a fourth or subsequent loan. It would require the lender to show evidence of a change in borrower financial circumstances to justify a second or third loan, and would impose a 60-day cooling off period, i.e. a period in which no additional loan could be extended to the borrower, covered loan could be extended to the borrower before a fourth loan. Debt trap protection. This would be an alternative for the lender to debt trap prevention requirements. On short-term covered loans, would require screening to determine that a loan would not result in the consumer entering a sequence of 4 or more loans, nor more than 6 loans total in a 12-month period. A maximum of $500 on the loan and 45-day term. No security interest in a vehicle, and a tapering requirement. Each successive loan has to be smaller, or no cost extension provisions have to be offered to pay off the third loan in the sequence. So again, these are alternatives to the debt trap prevention. On longer-term loans, debt trap protection falls in 2 categories of loans: National Credit Union Administration type loans, or NCUA, and maximum payment to income, or PI loans. On the NCUA type loans, there will be screening for income, no more than 2 longer-term loans in a 6-month period. The loan amount have to fall between $200 and $1,000, and the term 45 days to 6 months. The loans would have to be fully amortizing, meet NCUA cost criteria, which are a maximum APR, annual percentage rate of 28%, and a maximum application fee of $20. On the maximum payment to income loans, which are below a 5 payment to income ratio, again, screening for income, no more than 2 covered loans in a 12-month period, and limits payments to 5% of gross income during each payment period, fully amortizing terms of 45 days to 6 months. And the last thing I want to note here in terms of conditions in the proposed language is a record-keeping requirement on lenders. Lenders would be required to keep records on covered loans for 36 months after the last entry on the loan. A couple quick comments, and then I would be happy to try to answer your questions. As Chairman Block noted, I'm speeding to get up to speed on some of these issues. Market indicators of unaffordability might include the shares of loans. So again, looking at the market rather than the individual borrower to try to figure out the applicability of these sorts of regulations overall and what sense they make for the economy. Market indicators of unaffordability might include the share of loans for which the lender charged a late fee, the share of loans charge a late fee, refinance the loan, or sold the borrower a new loan with a very short window, i.e. created a sequence of loans. So we could look at the sequence data, try to understand affordability. Or in the case of payday loans, the deferred deposit transactions, the share that resulted in a return check, a bounced check. According to the Department of Business Oversight, in 2013, 5.8% of deferred deposit transactions resulted in a returned or bounced check, covering 6% of the dollar amount of the transactions for the year. About half of these bounced checks were eventually recovered, and about half charged off by the lenders. As noted above, national data suggests that about 2/3 of payday loan sequences are 1, 2, or 3 loans long, but that half of all payday loans are part of sequences of 10 or more loans. Lastly, in the longer-term CDLL market, the DBO data does not separately report original loans versus refinances, so it's actually not possible to draw out from their report the proportion of loans that are being resulting in late charges or charge-offs during a year, because there's an inventory of loans when you come into the year, and there's an inventory of loans at the end of the year, and they report new and renewed loans in the same category, so you can't actually parse out the appropriate data in order to do that calculation. I'd be happy to try to answer any of your questions.
Well, thank you, Mr. Saylor, for that clear and concise summary. Before we move to questions from the committee, I'd like to introduce two new members have joined us, Senator Mike Morell, welcome, Senator, and the chair of the Assembly Banking Committee, Assemblymember Matt DeBobney. Welcome, Matt. With that, are there any questions, comments from members? Mr. Senator Morell.
Thank you, Mr. Leonard. Appreciate this. Is not Mr. Leonard.
Jump gun, Saylor.
For down the road. Thank you.
No questions?
My
Any questions? Hearing none, I think a very complex issue. I think you did a really good job of trying to clarify for those of us. As we hear from all the additional speakers, all this will become, I think, much more real to us. Senator Hueso.
I just wanted to just expand, the conversation a little bit as to whether in your information you looked into some other decisions that have been made at the federal level that have led to some bank closures. And I know there were some decisions that got into some reporting requirements, and I know it's stemming from trying to reduce either fraud or money laundering at the federal level. It has really impacted border banks very much, and I've seen closures of many branches in my district, since I represent a border district who has already existing challenges getting access to capital. When we see bank closures in the district, we get concerned not only because it affects our unemployment rates, but also because it affects businesses' access to capital. Was that figured into the whole debate of changes at the federal level that are affecting access to capital?
Senator, that's not something I've looked into personally. My main focus here was to try to parse out the main portions of this particular proposal. I think it is important for the committee to think about the potential consequences of these regulations for the market, both for the availability of capital, availability of funds to borrowers. These are important questions, which is part of why I think it's very important to understand the duration of sequences, to understand the degree to which we might expect these regulations to drive some borrowers out of the marketplace, and what consequences those decisions might have for those individuals in California.
Thank you.
Yeah, thank you, Senator. And while that's a very important question, it's somewhat beyond the scope of these CFPB regulations. Thank you again for your testimony. Now it's my pleasure to invite up the Commissioner of the California Department of Business Oversight, Jan Owen, to talk about potential state regulatory impacts resulting from the proposal. And Commissioner Owen will again have 10 minutes.
Mr. Chair, thank you. Senators, thank you. Mr. Chair, thank you. Senator Wayso, can I get with you to try and answer your question that you gave to Brian? I will set up a meeting to talk to you about, you're talking about Bank Secrecy Act, I think, and the additional compliance standards that are going, that are affecting your border banks, and I'd be more than glad to set up some time to talk to you.
I just asked that in relation to kind of I always look at, access to capital as a very complete program. And I just thought I'd chime in terms of whether that's even being figured into in the whole conversation.
Thank you. Also, Senator Block, Department of Business Oversight is a no acronym zone. And there are little jars around the office that if you use an acronym that nobody knows, all the change in your pocket goes into the employee fund, and it works. However, that doesn't mean that we won't accidentally say some acronyms, and I have change in my purse.
And that's the DBO we're talking about?
You caught me. I can tell you we appreciate and respect the CFPB, I've got change, as a valuable partner in achieving the common objective, which is ensuring that crucial markets stay safe and healthy for consumers and businesses. However, that being said, I and my other state regulators don't always agree with the CFPB, and you don't want us to. That being said, the title of this hearing alludes to the balancing act that a financial service regulators must perform every day, which is we carry out our duties, we protect consumers, but we also make sure we don't unduly impede consumers and businesses. To borrow from the hearing title, we help make capital available, but also make sure that the consumers purchase a financial safety net and they don't end up buying a booby trap. As the CFPB navigates their regulatory process, I'm sure it will work properly to weigh the interests of consumers and businesses. No doubt you will hear today from witnesses who will have different views of whether the CFPB framework strikes the right balance. For our part, we are withholding judgment until they have something more fleshed out to consider, and we are part of a working group with other state regulators working with the CFPB on these. Our state have two laws relevant to this comparison: the California Deferred Deposit Transaction Law, or Payday, or CDDTL, and then the CFL Lenders Law. And then within the CFL Lenders Law, we have the small dollar pilot program. I'll refer to those. I'm going to not do a lot of repeating what the Research Bureau said, but to tell you how the California law works, so I can keep within my 10 minutes. For both the short-term and long-term loans, the CFPB proposal would give lenders the two options, two optional methods: the debt trap prevention, and you will hear this for many, many months, and the debt trap protection. Under the first, generally, lenders would have to determine the borrower has the ability to repay the loan, including the fees, on time and in full. Under the second approach, the lender would forego the underwriting, but the loan would be subject to restrictions, including caps on the terms and amounts. California's payday lending law and the CFL law do not provide lenders that kind of option currently. The short-term and long-term goals of the CFPB proposal defines the short-term loans as a duration of 45 days or fewer. It defines longer-term loans as those that have a duration that exceed 45 days and an all-in APR that exceeds 36%. California payday lending limits are the duration is 31 days. The CFL sets maximum terms based on the loan amount: 2 years for less than $500, 36 months for $500 to $1,499, 4 years for $1,500 to $2,999, and 5 years for $3,000 to $4,999. The CFL Small Dollar Pilot Program, and your staff member knows this better than I do, which it covers loans from $300 to $2,499, sets minimum, not maximum terms. The minimums range from 90 days to 180 days, depending on the amount. So with a minimum term of 90 days, pilot program loans would not be covered by the short-term component of the CFPB plan. I'm going through my notes because I really do want to, because you were asking for questions and answers. So the CFPB on the interest and fee limits plan proposes limits on interest rates and fees for long-term loans under certain conditions. Both the payday lending statute and the CFL statute limit interest rates and fees. California payday law limits fees to 15% of the loan amount. The payday statute also places limits on various fees associated with these transactions. Under the small dollar program, interest rates are capped at 36%, and the fees are also limited. Multiple outstanding loans. For both the short-term and long-term loans, the CFPB plan appears to require that borrowers have no current outstanding loans when they initially enter into a loan agreement with a lender. California payday lending statute limits borrowers to one outstanding loan at a time. California law bans rollovers. The CFL does not have any similar provisions. I'm going to conclude so we can have some answers. I got lots of smiles there, thank you. The CFPB framework and the California law intersect at many points. At these points, at some of these points, California law is stricter from a consumer protection perspective, and sometimes the CFPB is stricter. And occasionally, frankly, they offer just different approaches. We are going to closely monitor the developments at the CFPB as this framework evolves into a formal set of rules. However, one issue that's very near and dear to my heart and to the department's heart is how these will affect California law, and we want to make sure the CFPB regulations do not preempt California laws when our laws are stricter. So far, the CFPB has told us that they want to adopt something that will coexist with and not preempt state laws. Sounds like they're heading in the right direction, but we're cautious. We all have a long way to go. Working with the legislature in both houses is an honor and an incredible opportunity for the people of the state of California to try after many years to get these laws right. And I look forward to working with the legislature as we work with this, as well as with the CFPB. And I'm available for any questions.
Well, thank you, Commissioner Owen. I have a couple, and then other members of the panel may. You did a great job of comparing and contrasting California law
I
to
have more.
CFPB. A great brief job. Do you plan at some point to actually opine on the quality of the CFPB recommendations to CFPB to give them that input prior to finalization?
We are considering that, and there's a couple ways to do it. I've got a task force within the department to look at, see if that makes sense, but also because I belong, California as a state regulator, and we have a state trade association, this trade association is considering that as well at the federal level.
Okay, thank you.
And we would definitely work with you and your staff on that.
One other question for me. If once the final regulations are promulgated, is it your opinion that your department will have immediate authority to enforce the regulations, or does the legislature have to grant that authority to you?
I believe, and that's a tough question, but I believe the legislature will have to grant that.
Okay. All right, thank you.